Good day, City Hainan. This is again your teacher Pinky Rose Amira Oligo, for our new lesson. Today, I'll be discussing about forecasting revenues. Let's know our objectives. After reading this lesson, the learner should be able to first identify essential factors in forecasting revenues and cost, 2. Calculate markup and selling price of a product or merchandise, 3. Compute projected revenues, 4. Compute projected costs, and lastly, create a table showing projected revenue and cost. Now let's get started. Do you have any idea what is a business forecasting? All of your answers are correct. Business forecasting consists of tools and techniques used to predict changes in business, such as sales, expenditures, profits, and losses. The goal of business forecasting is to develop better strategies based on these informed predictions, helping to eliminate potential failure or losses before they happen in the business. So why do we forecast? That's correct. Forecasting is valuable to business because it gives the ability to make informed business decisions and develop data-driven strategies. Financial and operational decisions are made based on current market conditions and predictions on how the future looks. Past data is aggregated and analyzed to find patterns used to predict future trends and changes. Forecasting allows your company to be proactive instead of reactive. It is used to predict changes such as for your sales, expenditure, profits, and losses. There are three ways forecasting can help your organization excel. First, it helps set goals and plans. Forecasting allows businesses set reasonable and measurable goals based on current and historical data. Having accurate data and statistics to analyze helps business to decide what amount of change, growth, or improvement will be determined as a success. 2. It helps budget. Having visibility into potential trends and changes help businesses to know where to allocate their budget and time spent on certain offerings such as products, services, or areas internally such as hiring and adjusting strategy. Budgeting quantifies the expectation of revenues that a business wants to achieve for a future period, whereas financial forecasting estimates the amount of revenue or income that will be achieved in the future. Third, it helps anticipate change within the market. Having insight into not only current data but projections of what could happen in the future helps businesses to make adjustments to business strategy and alter current operations in order to change their outcome. Forecasting helps position business to become active instead of reactive. If there is a trend that is predicted to take over the market or data is showing changes in consumer behavior, it is important to readjust the market overall and optimize resources to stand out from the competition. Before we go ahead with computation, let's define the terms. First is revenue. Revenue is the result when sales exceed the cost to produce goods or render the services. Revenue is recognized when earned, whether paid in cash or charged to the account of the customer. Other terms related to revenue includes sales. Sales is used especially when the nature of business is merchandising or retail. Third is service income. Service income is used to record the revenues earned by rendering services. You have just learned about what revenue is. This time, let us study the various factors to consider in forecasting revenue. First is the economic condition of the country. When the country grows, its growth is experienced by the consumers. Consumers are more likely to buy products and services. The entrepreneur must be able to identify the overall health of the economy in order to make informed estimates. Second is the competing businesses or competitors. Observe how your competitors are doing business since you share the same market with them. Information about the number of products sold daily or the numbers of items they are carrying will give you the ideas as to how much your competitors are selling. Third factor is changes happening in the community. Changes happening in the environment such as customer demographic, lifestyle, and buying behavior gives the entrepreneur a better perspective about the market. The entrepreneur should always be keen in adapting to these changes in order to sustain the business. For example, teens usually follow popular celebrities, especially in their fashion trend. Being able to anticipate these changes allows the entrepreneur to maximize sales potential. And lastly, the internal aspect of the business. Another factor that affects forecasting revenues in the business itself. Plant capacity often plays a very important role in forecasting. Now that all factors affecting forecasting revenues are identified, you can now calculate and project potential revenues of your chosen business. Let's have an example. Miss Fashionista recently opened her dream business and named it RTW. It's an online selling business, an online selling business which specializes in ready-to-wear clothes for teens and young adults. Based on her initial interview, among several online selling businesses, the average number of shirts sold every day is 10, and the average pair of fashion jeans sold every day is 6. From the information gathered, Ms. Nista projected the revenue of her RTW online selling business. Another important information is that Ms. Nista gets her supplies to a local RTW dealer in the city. The cost per price is 90 pesos, while a pair of fashion jeans costs 230 pesos per piece. So let's check on how to compute the markup price. For the markup price, we have the formula cost times desired markup percentage. So the desired markup percentage depends upon you. You could choose to have it 50%, 20%, 30%, and so on. So for this example, we have the markup for the t-shirt, which is 90%, that's the cost, and then the desired markup is 50. So we have the example, markup for t-shirt is 45 pesos. Since we have determined our markup price, now we would need to have our selling price. Since the cost of the t-shirt is 90 pesos, then we have the markup price, which is the 45 pesos. So the formula for selling price is cost plus markup. So therefore, we have 135 pesos as the selling price. Let's take a look at this table, projected daily revenue. So we have here that RTW is sold, we have the t-shirt and the jeans, and we have the cost per unit, and then we have the markup, which is 50%, which give you this amount. Now, we have to add the cost and then the markup, which will give us the selling price, and then we have the projected volume. So for the shirt, the markup price is 45 and then the cost per unit is 90, giving 135 pesos as the selling price, and we have the projected volume daily that a consumer can purchase 10 t-shirts every day. So that will give us a projected revenue of 1,350 pesos every day. And then for the jeans, we have the cost of 230, added the markup of 115 will give us a selling price of 345. And then the projected volume for the sales of jeans is 6 pieces per day. That will give us a projected revenue of 2,070. So overall, we have here the total projected revenue daily of 3,420. Now that you know how to compute your projected daily revenue, then let's go on computing the monthly revenue. For the projected monthly revenue, we have the formula of projected daily revenue times 30 days. So for example, we already have the daily revenue of the RTW online business of 3,420. So we have to multiply it by 30 days, and that will give us 102,600 as our monthly revenue. So basically, what we're doing for projection is that we are just assuming that this will be our revenue or income for the next month or the following year. So since we have projected our monthly revenue, we have the yearly revenue, which is projected daily revenue of 3,420 multiplied by 365 days in a year. So that will give us 1,248,300 as our yearly revenue. Table 2 shows the projected monthly and yearly revenue of Miss Nista. the online selling business. So computations about the monthly revenue is multiplied by 30 days, and then for the yearly revenue, it is multiplied by 365 days. So given we have the following selling price for the t-shirt of 135 and for the jeans, which is 345, that will give us a total of 480. So remember that we are making projections. So projection is only like an assumption that this will be our revenue or income in a month or in a year. So given that we have 300 days for the volume of the t-shirt, because remember our daily is 10, and then for the jeans our daily is 6, so we only multiplied it by 30 days, so that will give us a total of 300 for the t-shirt. So multiplied by the selling price will give us an amount of 40,500 monthly. And then for the jeans, that's 62,100. And then, of course, for the yearly projected volume, we have to multiply the unit of the t-shirt that we are expected daily. So for the t-shirt, that's 10 multiplied by 365 multiplied by the selling price, which will give us a total of 492,750. And then for the jeans, that's 6, which is a daily unit sold, and then multiplied by 365 days will give us 2,190, multiplied by the selling price of 345 pesos will give us 755,550. So for the total monthly projected revenue, that's 102,600, and then we have the projected revenue yearly of 1,248,300. Do you understand? You got that? All right, let's proceed. Here are the important assumptions that you have to take note as we go along with this lesson, and we're going to do some computations. So we have here the following assumptions for the projected monthly revenue, which is an increase, because remember that not every month our projections could be increasing, it could also be decreasing. So for the projected monthly revenue, we have the formula. Revenue for the month of January, which is the beginning of the month, or sorry, beginning of the year, multiplied by 5% increase. So remember that we have the projected monthly revenue of 102,600 pesos multiplied by 5% will give us an increase of 5,130. So now that we have projected already for the increase, so we have now for the projected revenue of for the month of February, so we only have to add the beginning month of January, which we have the amount of 102,600 added the amount of increase, which is 5,130, which will give us a projected revenue of 107,730 pesos for the month of February. So do you understand that? All right, good job. On the other hand, decrease in revenue is computed as follows. So projected monthly revenue decrease, so is equal to revenue August times 5% decrease. So given the example, we have 144,041 pesos and 14 cents multiplied by 5%, so will give us a decrease of 7,202.06. Since we have computed already the decrease in revenue for the month of September, so we have to do the computation for the month of September. So for September, we have the revenue of 144,041 pesos and 14 cents minus the decreased amount of revenue, which is 7,202.06 or zero point zero 0.06 centavos. So we have the projected revenue for the month of September, which is 136,839.8 cents. Again, let's remember the important assumptions because these assumptions will be used as well in computing for your activity in your module. So for February to May, we have the increase of 5% from previous revenue. And then for June, there is a 10% increase from previous revenue. For July to August, that's the same revenue. And then we have the losses for September and October, which is 5% from the previous revenue. And then for November, well, we have 5% increase. And then for December, that's 10% increase from the previous revenue. So table 3 shows the projected monthly revenue. So remember that we have in the previous activity or computation, we have the revenue for January, which is a total of 102,600. And there is an increase of 5% up to the month of June. So we only have to multiply that for easy computation. You have to multiply it, the amount, 102,600 multiplied by 1.05, so that you don't have to add up the 5% from the previous revenue. You got that? Okay, let's continue. So for the month of July, remember that there is an increase of 10%, and we have to consider as well that months covering July to October are considered to be peak off months. Therefore, sales from July to October are expected to decrease. It is assumed that there is no increase in revenue from July to August, while from August to October, the decrease in revenue is 5% from previous month. Since revenue from sales of RTWs are considered to be seasonal, it is assumed there is 10% increase in revenue from November to December. So computation for assumed increase of revenue on specific months is as follows. So given the assumption, so we only have to multiply that for the certain percentages. So there we have the following. Let's do a recap. Can you still remember how do we compute for the markup price? Alright, very good. So for markup price, we are computing it by the cost times the desired markup percentages. And then for the selling price, we only have to add up the cost plus the markup cost. So therefore, if we are computing for the total projected daily sales, we only have to use the computation of selling price times the number of units sold in a day will give us the projected revenue daily. Alright, good job everyone! Forecasting the cost to be incurred. Again, remember, forecasting is a technique that uses historical data as inputs to make informed estimates that are predictive in determining the direction of future trends. Businesses utilize forecasting to determine how to allocate their budgets or plans for anticipated expenses for an upcoming period of time. This is typically based on the projected demand for the goods and services offered. Now, before we proceed, let's discuss the terms to be considered for forecasting the cost. Number one, we have the cost of goods sold. Cost of goods sold has another term of cost of sales. This refers to the amount of merchandise or goods sold by the business for a given period of time. This is computed by adding the beginning inventory to the net amount of purchase to arrive with cost of goods available for sale, from which the merchandise inventory end is subtracted. Merchandise inventory. Merchandise inventory refers to goods and merchandise at the beginning of operation of business or accounting period. Another term to remember is merchandise inventory end. This refers to goods and merchandise left at the end of operation or accounting period. So let's say this is the amount of merchandise left by the end of December 31 of each year. Another term is freight in. Freight in refers to amount paid to transport goods or merchandise purchased from the supplier to the buyer. Last definition is we have purchases. Purchases refers to the merchandise or goods purchased. Example, cost to buy each pairs of jeans or t-shirt from a supplier. So these are your purchases. Now that we know the definition of terms, we have to remember that in a merchandising business such as RTW, the formula to compute the cost of goods sold is as follows. So this is just an example of pro forma. So we have the merchandise inventory beginning, which happens usually in the month of January. And then we add the net cost of purchases, and then we also add the freight in costs. So that will give us the cost of goods available for sale. Then we deduct the merchandise inventory end by the end of the period or the year. So that is example December 31 of 2021. So we have the total cost of goods sold. So let us calculate the cost of goods sold of RTW online selling business for the month of January. So this is now our table 4. So we have here again the type of RTW sold. So we have the jeans and the t-shirt, and then we have the cost per unit, and then we have the projected volume, which is 10 multiplied by 30. So because we are computing for the monthly projected cost of goods sold, and then we have 6, which is the unit sold daily, multiplied by 30 days. And then we have to multiply the cost per unit times the average number of items sold monthly. So for t-shirt we have a total of 27,000, and then for the jeans we have 41,400, which gives us a total of 68,400. Table 5 shows how freight in is calculated. It is assumed that an average um, of 250 pesos for every 12 items delivered successfully by her supplier through a courier service by Miss Nista, which is the RTW online shop. Since her average order is 480 pieces every month, she pays 480 pieces divided by 12, which will give us a 40. So 40 times 250, that will give us 10,000 pesos as the total freight in cost for transporting the goods from the supplier to the seller or to Miss Nista, or freight in is then added to the net cost of purchases. So we have here a table which shows the computation. Do you understand? Let us now substitute the values from table 4 and 5 since there is no merchandise inventory beginning at the end. So let us add the cost of purchases and freight in to get the cost of goods sold. So for the inventory beginning we have 0, and then add net cost of purchases, which is 68,400, and then we have the freight in of 10,000. So cost of goods available for sale, that's a total of 78,400 less merchandise inventory and of 0. It's because we assume that we don't know yet the ending inventory. So overall, we have the total cost of 78,400. Now that the cost of goods sold is now calculated, let us now identify expenses that the business incurs in its operation. Operating expenses such as internet connection, utilities like electricity, and miscellaneous expense are important to keep the business running. These expenses are part of the total costs incurred by the business in its day-to-day operation and are paid every end of the month. The operating expense and assumed amount are presented below. So, example, we have internet connection of 1,299, then utilities for electricity, that's 800, and other miscellaneous expense, which is 300. So our total operating expenses every month is a total of 2,399. To calculate the total cost incurred by the business, cost of goods sold and total operating expenses are then added. The calculation for the costs incurred for the month of January is presented below. So cost of goods sold of 78,400 added the operating expense of 2,399. The total expense is 80,799 pesos. Again, let's take note of these important assumptions so that we will be able to compute for the next tables. So again, February to May, we have the increase of 5% from previous cost of goods sold. And then for June, we have the increase of 10% COGS. Again, COGS is short for cost of goods sold. And then for July to August, we have the same. September to October, we have a loss of 5% from previous COGS. And then November, there's an increase of 5%. And then for December, there's an increase of 10%. And then January to December, let's assume that our increase for expenses is only 2%. Table 6 shows the projected yearly cost for the first year. So for January, we have 78,400 COGS. And then to June, there is only a 5% increase. And see that our expenses, which is a total of 2,399, there is only an increase of 2%. So we multiplied 2,399 times 1.02 will give us 2,446.98 for the next month. Again, multiply it 1.02 for the month of March, and so on. So, do you have any questions? All right, let's proceed. Now, this time, it's your turn. Answer pages 15, 16, and 20 of your module. Again, please take note of the important assumptions of projected monthly revenue to compute for the activity in your module, and important assumptions of projected yearly cost.
Listening to my topic, and I'm looking forward for you in the next lesson. Thank you and have a great day. Again, this is Teacher Pinky saying take care, keep safe, and wear your mask.